Good evening, viewers. My name is Imran. I'm a UK and international tax specialist. Once again, I'm here with another interesting video. In this video, I will explain to the viewers how the group relief for the losses work in the UK, how the group of companies in the UK can transfer the losses in between. This video is with illustration and example, and I have added some screenshot from a real tax software which will help the viewers to understand this topic very well. After watching this video, you will do very well in exam and in practice. I suggest do not skip any part of the video because there is a lot of useful information in this video, and also do not forget to subscribe to my channel because I will be making more interesting video in relation to the UK taxes, financial reporting, financial management and performance management. So stay with me to the end. This topic is highly tested in ACCA, ACA and CTA taxation exam. It's also helping viewers how to relieve losses within the group in the UK. So this video is with illustration which will make it very easy for the viewers to understand the concept. Remember, once you understand the concept, you will definitely do well in exam and in practice, because UK taxes is about understanding the legislation, understanding the relevant points, understanding the relevant concept. Then the rest is very easy. The examiner cannot trick you. Even in practice, if someone asks you any question, you will be able to answer their question very well after watching this video. Let's begin. Group relief allows group companies to transfer the losses to a profit-making companies in the same 75% group. Condition is one company must be owned by another company at least 75%. For example, Y Limited owns 80% of Z Limited. So assume Y with a profit of 90,000 and Z Limited with a loss of 70,000. So remember, if you see Y Limited own 80% of Z Limited, so as Y own 75% shares, or at least 75% shares of Z Limited, so the Z Limited losses can surrender or transfer from Z Limited to Y Limited, thus as a result reducing the taxable profit of Y Limited and its corporation tax liability. So what will happen is, because of the group relief, so the Z Limited loss of 70,000 can be transferred to Y Limited profit. As a result, the Y Limited corporation tax bill will be lower. Now assume Z has a loss of 110,000. So in this case, the group relief claim here will be maximum of 90,000, because Y Limited has a profit of 90,000, even although the Z Limited has a loss of 110,000. So in this case, the Z Limited can transfer only 90,000 pound worth losses to Y Limited. So Z Limited will be having still remaining loss of 20,000, which can be carried back or carry forward. If you have seen my other video on trading losses, where I have explained how the loss relief work in the UK for a standalone company, so you must watch this video as well. Now, to understand the UK taxes, you need to understand the tax legislation, the relevant legislation, the relevant exemption. So for a group relief to apply, one company must be 75% subsidiary of the other, or they must be both, or they must both be 75% subsidiary of a third company. So that is a condition. For example, if T Limited owns 75% shares of Q Limited, this means that a losses from T Limited can be utilized against Q Limited profit, or the losses from Q Limited can be utilized against T Limited profit. They can go either way. So depend. If the company, one company, if T Limited is a profit-making company and Q Limited is a loss-making company, so losses from Q can be transferred to T Limited. Eventually, the T Limited taxable profit will be reduced. Remember, our aim, being a tax manager, to reduce the tax bill for the group. So we need to effectively utilize the losses. Similarly, if Q Limited is a profit-making company and the T Limited is a loss-making company, so they're both a group of companies. One owns 75% of others. So eventually, T Limited losses can be transferred to Q Limited as well. Please note, now, because that applies for the companies. Now, if Mr. U, this is an individual, owns 75% of Y Limited and 75% of Z Limited, the losses cannot flow between Mr. U and Y Limited and Z Limited, or in between two companies, because there is on the top, U is sitting on the top controlling Y 75%, and hence ownership of Z person as well, sorry, Z limited as well. So eventually this is not a group. For a group company, is if instead of you or individual you, if there would be a U limited owns Y limited and Z limited, so that would be like owns 75% of Y limited and 75% of Z limited. So this will be a group. However, here in this case, Mr. U is individual, owns 75% of Y limited and owns 75% of Z limited, even although he owns 75%. But in this case, the own individually, so that is not a group. Yeah, it is a group, but it's not a group for the loss relief purpose. Hence, the losses cannot be transferred between two companies. So condition is, however, if you look at the last line, however, if the two companies are each own 75% by the same parent company, that's condition, not by individual, by the same parent company, then the loss can be flow between all three entities. For example, A limited on 75% of B limited, and also A limited on 80% or 75% of C limited. So they A and B and C that are a part of group. However, if instead of A limited there's an individual A and then own B like 75%, and then he also owns C 75%, so that is not a group. If A would be a limited company, then it will be as a group for the loss purpose. So it means the losses between the group company can flow. For example, a loss-making company can transfer the losses to a profit-making company. So that is the condition you need to remember. Focus an exam, you will be tested, so bear in mind. So make sure you know you have the relevant knowledge. So from practical point of view, for 75% subsidiary, the following three conditions must be met. The parent company owns at least 75% of ordinary shares capital of the company. Then the second is the ownership entitled the parent to at least 75% of distributable profit, is mean the dividend. And number third is the ownership entitled the holder to at least 75% of the company asset that are available in event of winding up. For example, if the business is winding up, this entitled the holder to receive at least 75% of the company assets. So that is make it as 75% group company. Here's the illustration. Parent co, so they own 82% of P limited, and then the P limited in turns own R limited 92%, and then the parent co owns 85% of A limited, which in turn hold 80% of the B limited. So work out how many group of the companies or which companies are a part of the group and which company can surrender the losses in between. Remember, when it's come to exam and in practice, make sure you don't stay quiet. So pick up the easy mark. So easy mark is for you is the parent co and P limited are in 75% group. Remember, parent co hold directly 75% of P limited. So that is obviously you get 1 mark. So now let's see if the parent co also holding 75% of R limited. So to work it out, so you need to multiply 82% and 92% together, so it will give you 75%. Therefore, parent co also holding R limited, so all forming a 75% group for group relief. Now let's turn to the right side. So parent co also holding 75% of A limited, that is very obvious. Now you see if parent co also holding 75% of B limited. So for this reason, we need to multiply 85%. If you look at the diagram, you will see clearly. So 85% multiplied by 80%, that gives you 68%, hence less than 75%. So the group is not formed between parent co and B limited. So the group relief is therefore, so there are two groups we can see, the parent co plus P limited plus R limited and A limited. So this company can transfer the losses in between. Then there is another group as well, the A limited, so plus B limited can also form a separate group because A limited owns more than 75% shares of B limited. Remember, a company can participate in more than one group for group relief purpose. Now, which losses can be transferred between the group companies? The UK tax legislation states that surrendering company or the loss-making company may surrender the following losses. Trading losses, that is very obvious. Number 2 is non-trading losses, for example, interest deficit. Number 3 is excess qualifying charitable donation that can be transferred between group companies. Number 4 is excess UK property business losses, excess management expenses. Number 5. Number 6 is excess non-trading intangible fixed asset losses. Now, the surrendering company, remember the rules, surrendering company surrender to the profit-making company, which must, so the profit-making company must set the losses against the total taxable profit of the same accounting period. The second line is very important. The claimant company or the profit-making company must use these losses in the current accounting period. So the claimant company cannot carry back the losses or carry forward or transfer to another group company. They must use it against the total taxable profit of the same accounting period. So they cannot just carry back or carry forward because these losses came from another company. So they must set it against their own total taxable profit of the same accounting period. It's good to understand the rules because once you know the rule, you cannot be tricked even in exam and in practice. So the offset amounts against the total taxable profit will be made after the qualifying charitable donation. So it means we make a claim for the charitable donation. So the charitable donation will reduce the total taxable profit, which is a good thing, and any brought forward losses. So if the claimant company has some brought forward losses, that can be used first before making any claim for group relief. However, the offset will be made before the losses carry back. Remember this thing, sometime examiner can test you. This is illustration number 2. It's good to have illustration to understand the concept very well. So there are two companies, Gold Limited and Silver Limited. So both has a trading loss. One has a trading loss of 10,000. They are 75% group companies. The other one is with a 50,000 trading loss. Then this Gold Limited has a non-trade interest income of 30,000. The Silver Limited has a trading deficit, non-trade interest deficit of 3,000. UK property business income of the Gold Limited is nil, 0. Silver Limited has a UK property business income of 20,000. Gold Limited has a qualifying charitable donation of 2,000. And the Silver Limited didn't make any qualifying charitable donation. Work out the available losses for Silver Limited after the group relief and the loss claims. So it's very simple. It's a basic example. You can see here is we're talking about Silver Limited. So remember, Silver Limited has a trading loss of 50,000 and they had a non-trading deficit of 3,000. So the total is 53,000. So it's very basic. Now we need to use that 53,000 against how we can use it against the current year income and how we can make a group claim as well. So I will show it to you on the following slide. Now the Gold Limited, so that they don't have any trading profit. However, they have non-trade profit, which is interest. They receive any interest, from bank deposit of 30,000. So then they will use the current year loss because they have a trading loss of 10,000. So eventually their taxable profit will be 20,000. They will utilize the charitable donation as we stated on the previous slides. So they will use the current year losses first before ask for group relief, and they will utilize the charitable donation. Eventually their total taxable profit will be 18,000. So the charitable donation are not wasted. Now this 18,000, now they can ask for a group relief from Silver Limited. So first of all, they will utilize their own losses. So that is the rule. So they will utilize their own loss. They have a trading loss of 10,000, which will be used against non-trading profit, which is the interest income. So eventually their total taxable profit will be 20,000, which will be further reduced by qualifying charitable donation of 2,000. So their total taxable profit will be left 18,000. What they can do is they can borrow or they can claim 18,000 of loss from the Silver Limited because they are both 75% group companies. Eventually the Silver Limited loss or trading loss will be used against their profit. So the Gold Limited revised total taxable profit will be 0. Hence the Gold Limited will not pay any corporation tax, so which is a saving for the group. Now what will happen to Silver Limited? Silver Limited has a total loss of 53,000. 18,000 will be used against the group relief of you can see against the Gold Limited profit, less they will use 20,000 against the current year claim in the Silver Limited. Remember, Silver Limited has a property income of 20,000. So they 53,000. So the way 53,000 we will use. So we will use against the property income of 20,000. 18,000 went to the Gold Limited. Hence, we still left, or the Silver Limited still left with 15,000, which will be carry forward. So eventually, the Gold Limited doesn't pay any corporation tax. If we won't have utilized these losses, Gold Limited will have to pay tax or corporation tax on this £18,000. Because of the group relief, they don't need to pay any corporation tax. However, the Silver Limited utilized the losses and they have still left with £15,000 carry, so they can be carried forward and set against the future profit. Now, the legislation also stated, because there's a more flexibility these days, so for the losses on after 1st of April, we're talking about the brought forward losses. We dealt with the current year losses. Now, there is another option. If the group has the brought forward losses and that losses arises on or after 1st of April 2017, which hasn't been utilized in the year, it is possible for a group relief to be surrendered brought forward losses to another company, which is a good news for a group of companies. The list includes trade loss, which losses can be surrendered. If these losses are after they're brought forward losses and they arise after on or after 1st of April 2017, they can be transferred for group relief, which is very simple. So the list includes trade loss, as we stated, if you have seen the other slides. So there was trade loss. So remember, in the year relief, so if I said to you, like, if one company is a profit-making company and the other company is a loss-making company during the same accounting period, so the loss-making company, if they're a 75% group, so the loss-making company can transfer the losses to the profit-making company in the same accounting period. However, there's also flexibility for group relief for brought forward losses. So the brought forward losses, any losses on or after April 2017, which hasn't been utilized in the year, it is possible for the group company to surrender brought forward losses to another profit-making company. So the list includes trade loss, so that trade losses, any brought forward trade loss can be transferred or surrender. Non-trade loan relationship deficit, for example, any interest deficit. Non-trade losses on IFA. IFA means intangible fixed asset. Excess management expenses, UK property business on or after 2017. So also remember, not just only for current year losses, any losses which are brought forward and arises after 1st of April on or after 1st of April 2017 can be surrendered for group relief, which is amazing. Now, group relief for carry forward losses restriction. When there is a good news or there is some flexibility or some relief for the group, it's always come with some restriction as well. So the restrictions are as follows. Where a company in investment business has become small or negligible before the beginning of the current accounting period, or where surrendering company has no income generating asset at the end of the surrendering period. It means the losses for the brought forward losses on or after April 2017 cannot be made if that is the situation. Number two, only surrender those brought forward losses if it is not possible to use those against its own profit of the later accounting periods. It means if it's possible to use against its own accounting period, so make sure you don't make any group relief claim. Now, continuing with the restriction number 3, a company which has its own brought forward losses must utilize those losses before making or before claiming group relief for the forward losses of another company. So that is a need to remember. Number 4, where the company profit for the accounting period after deduction any current year relief exceed the deduction allowance. Remember, if you have gone through, or if you have seen my other video on the trading loss, there is a restriction of 5 million. So the deduction allowance is 5 million. So the company may only offset a maximum of its deduction allowance, which is 5 million, plus 50% of its profit in excess of deduction allowance. You need to remember, so there's a deduction allowance plus 50% of its available profit in excess of the deduction allowance. I will show you with illustration. Very interesting and super challenging and very hard as well. You need to pay attention. 275% group companies have the following results for 31st March 2023. East Limited and West Limited. East has a trading profit of 10 million or trade profit of 10 million. West has a trade loss of 7 million. West has a non-trade profit of 15 million. East has a UK property business income of 5 million. Assume the deduction allowance will be split equally between the companies. Both companies are 75% group. West Limited non-trade loan relationship, LR stand for loan relationship. It means like interest. Deficit interest is like bank deposit interest. Deficit brought forward of 3 million, and East has a trading loss brought forward of 15 million. All brought forward losses are after 1st of April 2017. Calculate the taxable total profit for each company after making loss claim. You have to pay attention to this very interesting example, very important. Pay attention. So on the following slide, I will show you how you can deal with this. Now you have to be very vigilant. So vigilant to deal with this kind of question. So you will start with the East Limited. So East Limited has a trade profit of 10 million. They have non-trade profit of 5 million. So they have a total profit of 15 million. And they have the brought forward trade loss of 15 million as well. So when it's come to the brought forward losses, remember there's a restriction applied, which is the annual deduction allowance of 5 million. And then remember that formula, the one I mentioned on the previous slide. So there's no restriction where you utilize the current year losses. For example, if that would be the case, if there would be a trade profit of 15 million and there will be non-trade loss of 10 million, so you could use the 10 million against the 15 million profit. So there is no restriction for the current year losses. However, when it's come to the brought forward, there is a restriction. So the restriction is 5 million plus 50% of the profit over the deduction allowance. So then in this case, remember, as we stated, the deduction allowance is available, the annual deduction allowance is available for the group. So that 5 million can be split between the group company the way you want, the way you can have better tax saving. Here we stated an example. Let's assume that this will be split equally. So there are two group of companies. So the 5 million allowance is being split between two companies. So 2.5 million plus 50%. Remember, the total profit is 15 million. So 15 million minus 2.5 multiplied by 50%. Okay, that would give you the annual you can claim, like the maximum you can claim the brought forward losses. So in this case, the total taxable profit will be 6.25 million for East Limited. Now it's come to the West Limited. Remember, the West has a trading loss of 7 million. So there's no trade profit. They had the non-trade profit of which is interest income of 15 million. So what will happen is, before making any loss relief claim, they will use their current year losses of 7 million. If you look at the previous slide, and then after that, less brought forward non-trading deficit interest of 3 million. They can use this one as well. And the rest they can ask for the group relief from the East Limited. So the East Limited, remember, the relevant maximum would be 2.25 million. And the available losses of the East is, remember, East had the available loss, they had the brought forward loss of 15 million. 8.75 has been used against its own company, which is within the East Limited. So they still have 6.25 million left. However, the maximum they can use is, or the maximum they can surrender against East Limited is 2.25 million. I will explain to you why on the following slide. So the revised total taxable profit of West Limited will be 2.75 million. So you will start with East Limited. So East Limited total profit, then use the brought forward losses, but make sure restriction apply because of the annual maximum deduction allowance. Remember, we say assume the deduction allowance is available for the group. If it's a standalone company, so 5 million is available for each company. But as a group of companies, there's only one deduction allowance of 5 million. So you have to split it the way it can generate the best tax saving for the group. Here we're saying is, let's assume it will be split equally. So when it's split equally, so this is the technique you need to use. I have prepared a video, another video on trading losses, which will give you better clue. So here we discussing the group relief. So I'm not going to go back and explain how the trade loss work. So you need to go and visit my video and go through my video. There are various slides which will explain to you in more detail. Now, when it's come to East Limited, East has a brought forward trade loss of 15 million. They set 8.75 against its own profit. So they left with 6.25 million. They surrender for a group relief to the West 2.25 million. I would say is on the there is explanation below why they limit this amount to 2.25 million. So there's explanation for the relevant maximum. Remember, West, so we say is there is an annual deduction allowance of 5 million for a group, for the entire group. Then we stated that it should be split. Okay, in practice, you need to utilize in the way it generates the bigger tax saving. That is the rule. However, we just, for the simplicity, we say let's split it half. So we say 2.5 million, and then the taxable profit. So the other rule is plus 50% of the profit in excess of this annual deduction. So annual deduction, we're saying 2.5. They have a profit of 8 million. So the maximum they can use of brought forward losses is 5.25 million for West Limited. However, West must use its own non-trade deficit brought forward of 3 million. If you look at the previous slide, we clearly stated that they have the brought forward non-trade loan relationship deficit of 3 million. So they use this 3 million if you look at the calculation. So then for the rest is the maximum they can use is 5.25, the brought forward. Hence, the remaining part is 2.25 million. They can ask or they can claim from the East Limited. So you have to be vigilant, watch the wording, what the examiner states to you, and then you can do very well. This is the loss optimization. Our preference would be for claim in the following manner: current year first and then carry back. Group relief, surrender for group. First, we need to see if we can use it against the company own profit, and then thinking of group relief. Or we carry back. With the carry back, you will have a tax refund because you already paid tax in the previous year. This year you made a loss, you can carry back and you can ask for a tax refund. Or the other option is for group relief, surrender for group relief, or carry forward and set against future profitability. The main aim is to reduce the corporation tax bill. Since the corporation tax rate increased to 25%, if you have seen the HMRC legislation, it will be worthwhile to carry forward the losses in 2022. Remember, in 2022-23, the tax rate was 19%. So there is no point to carry back and ask for only 19% relief. Rather, we carry forward and can have bigger relief in the form of 25%. So that would have a bigger tax savings. Now that's how the things look in practice. This one I have taken from my own tax software. If you look at the Schedule B, so this company has ABC company. So just for simplicity, I can't use like a proper client account because it's illegal. I'm not allowed to use or publish any client information. Here I just created a dummy ABC company. So if you look at the Schedule B, the profit and loss per account is, or P&L from P&L or profit and loss account is 8 million. There's a loss. So the company has a depreciation which you need to add it back. They have the client entertainment which require addition because they are not permissible or not allowable. Accountancy, a legal fee or professional fee in connection with the share purchase, also not allowable. Provision for bad debt is also not allowable. So hence we need to add back 85,000 because as a result this will reduce the losses available. Eventually the HMRC will have more tax collection. And then they have the profit from non-trading loan relationship, which has an interest income. So you need to deduct that one, okay. And then obviously property income per account. So they have a property income of 300,000. So you need to add back disallowed expenses and deduct those income which will be taxed under different schedule. So they have a trading loss of 8.715 million. So remember, if you look at Schedule A, so they have interest and profit from non-trading around relationship. So remember, in Schedule B, that was a 500,000, and they have property income. So they have total taxable profit of 800,000. So now, if you don't use the trading loss, the one in Schedule B, so eventually what will happen? You need to pay corporation tax. So what we did is we used 100,000 worth of trading loss against other income. So eventually there's no corporation tax payable. That's how it looked like in practice. That's you making. So that we call it like a current year claim. So here we had the trading loss we set against the current year total profit, which was in the form of interest income and the property income. So that is the first claim. That is a loss summary. Even examiner would expect you to make some loss summary. Remember, loss in the period, trading loss for the period is 8.715 million. We set losses set against other income and gain. If you see the previous slide of the property income and the interest income, and then we decided to losses set against group profits. So we decided to transfer 6 million to a group company. So the group company, I just created another group company. So that's how it looked like in practice, how you're going to transfer the loss summary. So the first you make a current year loss claim, and then any losses left, then you can think to surrender for a group company. So we're still left with a trading loss to carry forward arising after 1st of April 2017. So how this look like in practice? If you wish to know more about tax training, I can train you more in real life as well, but it needs some time. So you need to drop me a comment. I can do some training for you. Finally, thanks for watching. I hope you found this video useful. Remember, once you have the knowledge, the examiner cannot trick you. You will also perform well in practice. My aim is to give you confidence, knowledge that you need for your exam and in practice. Hence, your chances for employability will be high. Do not forget to share, like, and comment. The reason I'm saying is it's not only exam. Just pass ACCA. Sometimes some people pass ACCA and they're still struggling to find a job. Even their ACA and they still struggle to find the job. The reason being is the knowledge is the key. Once you have the knowledge and you have the skills and the confidence, you can go. If you're in interview, in interview they will never say to you is can you calculate corporation tax or can you work out the group relief. They will be asking what's the annual deduction, how does it work, how for the group of companies, how these things work, what are the capital allowances, explain to me like this. What is long life asset, in which pool it goes. There will be some technical questions. So that's why you need to remember the legislation. You need to remember the relevant points to do very well, to have edge or other people. So also hit the subscribe button because I'll be making more useful video like this to benefit you. Remember, the group relief is still, I need to cover some more aspects. For example, what will happen is if a company, if they have different accounting period, for example, one company has an accounting period 31st December 2023, the other has accounting period 31st March 2024. So there will be some overlapping. Or what will happen is if a company joined the group halfway through, or what will happen is if the company left the group in the middle of the year. I will be making a separate video for this. However, it's need time. I just need to work it out to make sure that you benefit the most. This topic, it might not be tested in your ACCA F6. However, it will be tested in your P6, the advanced taxation. Now it's time for me to say a very good night to you.